Good afternoon. Uh, this afternoon, we're going to cover chapters 19 and 20. This is the beginning of week 7 in our course. And chapter 19 is using the securities markets and financial markets to invest and for investing opportunities. And then we'll cover chapter 20 this evening, which is about money, the Federal Reserve, and the various banking institutions, which are many and varied. So we'll cover chapters 19 and 20 this evening. Next week, we will be back to cover chapters, bonus chapters A, B, and D, or A, C, and D, I think it is, excuse me. Yeah, A, C, and D, excuse me. And that will be next week at the same time as tonight. So let's look at the learning outcomes, learning objectives for Chapter 19. Describe the securities markets and the role of investment bankers. Identify the stock exchanges where securities are traded. Compare the advantages and disadvantages of equity financing, which is done by issuing stock, and the difference between common and preferred stock. And then we're going to compare the advantages and disadvantages of obtaining debt financing by issuing bonds, identify the classes and features of bonds. We'll explain how to invest in securities markets and set investment objectives such as long-term growth, income, cash, and protection from inflation. We'll look at the opportunities that stocks offer as investments. We're going to analyze the opportunities that bonds offer as investments. We'll explain the investment opportunities in mutual funds and exchange-traded funds, ETFs. And then finally, describe how indicators like the Dow Jones Industrial Average affect the market. And one thing I want to say to you right at the beginning is that, and we'll mention it when we get there, is that the Dow Jones Industrial Average, which most of you know of, you've heard of, the most commonly quoted stock market value, if you will, or that gives us the value of the stock market, is not the most accurate. So keep that in mind and we'll get there. So here we are in chapter 19. We're going to look here at the first slide, talks about the basics of the securities markets. This is a place, a market, is a place where the buyer and seller meet to make some type of trade. And what we have here for the most part is that this type of market does not exist like the market around the corner does, or like the farmer's market in your hometown does or in your community does. This is normally, but today, this is normally done via the internet. Those types of trades are by telephone, most times not directed by the person who wants to make the trade, who has to make the trade, or buy or sell. Of course, that person could go to his local stockbroker or her stockbroker and initiate an action. But normally speaking, that just does not happen today. So the market does two things essentially. It assists investors either way, and businesses, particularly in finding long-term financing for their capital needs. And then for people like you and me, the individual investor, it helps us a place to buy securities such as stocks and bonds to increase our wealth, if you will. Now, the types of securities markets is the primary market, which, as you can see on the slide, is the market that handles new securities. This is something that has not been offered to the general public previously, and I'll come back to that in a second. And the secondary market handles trading securities between the investor, that which could be a person like me or a person like you, with the proceeds of the sale going to the seller. So I want to buy some stock, and so I go to my stockbroker and I say, okay, I want to buy XYZ stock at $10 a share, and he says or she says, well, it's trading right now at $10 and nickel. Do you want to do that? The person says yes. So I want to buy 100 shares, and then he or she makes that transaction, and that money that is paid to the broker who's facilitating that then goes to the seller, whoever's selling that stock. And of course, the broker is probably going to get some kind of commission. So he or she will say, whatever that sales commission happens to be, X number of dollars per trade is usually what you see. Initial public offering goes back to this primary markets handling the sale of new securities. Initial public offering means it's not been offered to the public for sale anymore. Before, excuse me, not anymore, before. And we see these happening on a fairly routine basis. I can't give you any one particular one, although I believe, if I'm not mistaken, Snapchat, which I believe is a social media outfit, just recently had an IPO, initial public offering. I can't tell you what the stock was traded for, but it's something you can find out. You could go to Google or some other search engine and type in Snapchat and find out what the offering was. Investment bankers are different than the banker that we deal with down the street. These are people who assist businesses for the most part. It talks about investors as well with the issue and sale of new securities. So we're back to this primary market, initial public offering, or something of that nature. Institutional investors are just what they say. These are large organizations or an organization that represents a large number of people. To give you an example, what I'm talking about is CalPERS. CalPERS stands for the California Personnel Retirement System. I cannot tell you how many people are in that system, but what I can tell you is that CalPERS is a huge, huge trader, and it trades in the hundreds of thousands, if not millions, of shares of stock on a daily basis. So that's what it does there. This is here, such as pension funds. Of course, organizations do this as well, just as CalPERS does. Now, we're going to have a slide here is what's known as the top stock exchanges in the world. The New York Stock Exchange. Notice it says New York Exchange, NYSE Euronet. That's because Euronet bought out the New York Stock Exchange several years ago, although it is still commonly referred to as the New York Stock Exchange. And then we have the NASDAQ, which we'll explain a little bit later. That's an American stock exchange that is totally online. Now, what do I mean by that? Well, the picture that you can see over here to the right on your screen shows the New York Stock Exchange trading floor. And there are actual people, traders. If you click on your television on CNBC, there's a couple other financial channels. I just happen to turn on CNBC more often than any other, not for any particular reason, but I just do. I can actually see traders on the floor. You will not see that with the NASDAQ. London Stock Exchange, also referred to as the FTSE, Financial Times Index. Then we also have the Tokyo Stock Exchange, and I can't give you the name in there, and the Deutsche Börse, which is the German stock exchange, and then there's the CAC, which is the French exchange. And there are other ones around. Those are just the ones that come to my mind, not necessarily that they're one's any better than the other. The Securities and Exchange Commission is a federal agency that was implemented, as the slide says, by an act of Congress in 1934, and they are That commission is the overseer of stock exchanges. And then the next thing that we have down here is something that is very important. And I want you to take this away with you and put it in your mind, in your memory bank, especially if you've never made an investment in the stock market and you're thinking about doing that. And that is that anytime you wish to go with somebody in the stock market, a mutual funds or a individual stock, or even electronically traded funds, electronic funds. I always get that messed up, and I'll correct that when we get there. You have to get a prospectus. A prospectus is required whoever is facilitating any type of exchange, or if they're trying to sell stocks or mutual funds, etc. They have to provide you with a prospectus. A prospectus will tell you what the stock has done in the past. I'm using the term stock here, it could be a mutual fund, or what it's done in the past, and will give you a prediction of what they expect to do in the future. But that will come with a caveat. And the caveat will say past returns are no prediction of future returns, or words to that effect. But you have to get a prospectus, and somewhere in the prospectus many times it will tell you that this particular stock or mutual fund or electronically traded fund has a rating from Morningstar of X number of stars. By the way, Morningstar is the video for chapter 19. It's a review, very interesting video, especially if you want to invest or if you have never invested in the stock market. Morningstar is a place to go. Morningstar is not owned or has any relationship with any investment organization. And so what you're getting there is objective views. Regardless, you have to have a prospectus. If you want to invest and you weren't sent a prospectus, you should contact the Securities and Exchange Commission. Now, what we give here is the language of stock. A stock is, these are stocks also known as shares. When you have those, it says that you, Mr. Smith or Miss Jones, is an owner of XYZ Corporation. Now, years ago, and not that many years ago, companies used to issue what are known as, in the next bullet, stock certificates. And you got a certificate, and it usually had your name typed on it, and it said that you own X number of shares in XYZ Corporations. Companies no longer issue stock certificates. That will be issued to you electronically, and it will say through for lack of a better term, a holding company, and it will say that you own so many shares of this particular stock in this particular company. But you won't physically have something in your hands to say that, yes, I own this particular stock. Now, I'll give you an example. My wife and I own Coca-Cola stock, and we do have certificates. But any stock that we have bought, and I can't remember the exact date. I want to say it's like after 2005, although it might be a little bit before that. We'll get a notification that we have X number of shares, but we do not get a certificate. And one of the things I want to tell you is a certificate is negotiable. You can go to your broker. Now, every broker may not take it, but you could go to your broker and say, I've got this many shares of stock, I want to sell them, and they can facilitate a trade base, because there'll be a number on there that says, yes, that this person is a stockholder. A dividend, remember, is something that we've talked about. We will talk about this in the course quite frequently, or we have talked about it, we'll mention it again. A dividend is something that a company pays after taxes to its shareholders. Companies do not have to pay dividends ever, ever, never, never. It's not a requirement. For a long time, many of the .com or computer companies like Dell, and I'm only using Dell as an example here, and I'll explain why I don't want to be using an example in a second, did not issue stock, did not issue dividends. They would take the profit that they earned and plow it back into the company, which is perfectly acceptable. All that meant was the shareholder didn't get dividends. The reason I mentioned, I said, come Dell back and talk about it again. Dell is now a privately owned company. It is not traded on any exchange. But I only wanted to use them as an example. And notice here that if you do issue stock, or if a company does issue stock, it improves the balance sheet, but and it improves the balance sheet in this way because there's no debt created. It's much different than going out and trying to do something by taking on debt, which would be either issuing bonds or buying a bond. Well, excuse me, if you buy a bond, you're not taking on debt because you're a bond holder, or the bond issuer has to pay you back. So it's a little bit different. But if you issue bonds, then you're taking on debt. These are the disadvantages. And one of them is that a stockholder has a right to vote in the annual election. The stockholder has a right to, for the most part, not always, but for the most part, vote on people who are being promoted, or being, promoted to for election to the board of directors. They can also vote on various other issues that come before the stockholders, like pension plan and other type things, and that's an issue. If the more stock is issued, that can dilute the firm's ownership. It will also dilute the value of the stock. So if more shares are issued, because there are more shares out there, and the stock may not be will be a little bit less robust, for lack of a better term. Dividends paid after taxes, and that's not a business expense. And then there can continually be a fight between stockholders and management, stockholders are becoming a little more active or proactive today and not taking the company line. Unfortunately, at least as far as I'm concerned, now I'm not speaking here from personal experience. But what I am saying is, unfortunately, many companies do not pay enough attention to the stockholders. And so they'll do things against the wishes of the stockholders, and even though stockholders have voted against a particular person being to the board of directors, that person will be retained. And stockholders many times don't have a lot of leverage, simply because they don't always know things. And this is very, very disconcerting, because if it weren't for stockholders, the companies probably wouldn't be in business. Now, somebody's going to say to me, well, wait a minute, that's not right. If it weren't for the consumer, the company wouldn't be in business. That's true in and of itself, but it's the stockholder who put his or her money up to buy shares of stock that lets the company be in business in the first place. All right. So let us move from there to talking just a little bit more about stock. There are two classes of stock. There's common stock and preferred stock. The most often issued is common stock. Notice it says it's the most basic form. People who hold common stock, my wife and I hold common stock. We don't hold preferred stock. We have the right to vote for the board of directors, and we can share in the dividends if dividends are approved. Now, you can also do this with dividends. several of the stocks that we own, we have what's known as dividend reinvestment. And so when a dividend is declared, those dividends are not paid to us in cash. They're paid to us in the fact that we bought more stock. It's something that we want to do. Now, every company that we own stock with does not do that. One particular company that I can think of, we get a quarterly check or so. Yeah, right. Based upon the number of shares times the dividend. A preferred stock owner is exactly what the word preferred says or means, that have a higher standing. So those folks get first dibs on dividends, and they can also do certain different things. Could be callable, and what you'll understand that when we get to callable bonds. They can be convertible. You can convert them to other type securities, and they can also be cumulative. So now we talked about stocks, and remember, that is equity. That is within the company. It is not taking on debt. Bonds, on the other hand, are debt. Notice the first statement up here. It is a certificate, same way as a stock certificate is, even though they're seldom offered, seldom given to investors today. That says, I am an investor. I bought this particular bond, so in effect, I have lent the company X dollars. Now, whatever that happens to be, bond that's selling $1,000, or the government. If you buy government bonds, the government is a debtor to you, and the government must repay the face value of the bond. We will go over this again later, plus interest. Now, it used to be that Class E bonds, or double E bonds, or triple E bonds, I don't remember what the designation is, were redeemable after 10 years. That's no longer true. It's 30 years. Now, if you want to cash in your bond before the 30 years, you're going to get the face value of the bond back plus interest up to that date. But for instance, if you bought a $100 bond, you pay $50 for the $100 bond, and used to be you held it 10 years, you get $100. Now you hold it 30 years, you get $100. So if after 10 years you want to cash that bond in, you're going to get your $50 back plus whatever interest has accrued over 10 years. But it won't be enough to make up that $100. There'll be some shortfall in there. I can't give you a figure. I would suspect it'd be somewhere in the neighborhood of $60, a little over 60, something in that nature. We have to remember something, that the interest on the bond must be paid, and it must be paid per schedule. Some of them are paid annually, some semi-annually, some quarterly, but it must be paid. And then, of course, the entire face value of the bond must be paid at maturity date. Now, notice down here at the bottom, the last bullet, it says bonds can be repaid before the maturity date, if they have a callable provision. And one of the reasons that companies want to put a callable provision in there is that it's possible that the interest rates will drop, and then they can buy the bond back and reissue bond at a lower interest rate. Now, the one thing to understand here, if the bond is bought back early and has a callable provision in it, there's normally a premium paid. So the investor will get his or her original investment back, let's say $1,000, and some interest. It won't be the entire interest that he or she could have expected, because the bond was bought out early. So there's another advantage of issuing bonds, besides it being a temporary source of funding is that the interest rate is a cost of doing business, and therefore it is tax deductible, the interest rate. So if you have a bond that's a $1,000 bond and you have to pay 5% interest a year, that's whatever that happens to be, that can be taken off however many times, however many bonds that you have issued. That is a business deduction. Now here's the disadvantages. First of all, the first thing it does is increases the debt. And once the debt is increased, firm's debt, an investor can say, you know, I'm not so sure about this company, it's got too much debt. You have to pay the interest. You don't have a choice in saying, I'm not going to pay the interest. That, you know, you don't have that choice. You have to pay the interest. Obviously, you don't pay the interest, the bondholders can take you to court. And the face value, as I've said before, has to be paid on maturity date. Now, of course, you know, you can negotiate and have callable bonds and certain things of that nature. But that is something that you really have to pay attention to because that's not something you're going to get away from. Now, this particular slide we have here is the bond ratings, which you can see in your textbook, figure 19.3 at the top of page 541. I'm not going to go through these with you. You can look at them yourself. Just understand that whatever's at the top is the best, and whatever's at the bottom is not good. You're getting down here into speculation. Now, the thing about these speculative stocks is this. If you get in on the ground floor and buy one of these speculative stocks and speculative bonds, and the company does well, you can, you know, really make a killing. But conversely, you could lose your shirt. So you really have to pay attention when you get down there. You've got to pay a lot of attention to whether or not you want to do that. One other particular figure that I want to call your attention to is on the opposite page, page 540, and that is figure 19.2. And it gives you the various types of bonds that you could possibly buy if you were interested in it. Just look at those. It's not something that you really have to pay a lot of attention to. It's just interest for you, so you have some idea of terminology. Now, corporate bonds come in two different flavors, if you will. And one is a secured bond, and the other is an unsecured bond. Unsecured bond is not backed by anything that is specific. Remember, look at the term we're using here as collateral. Collateral is something like land or buildings or machinery or something of that nature. Unsecured bond, really what this boils down to is you're getting a bond based upon your name, your character, your reputation, etc. And then a secured bond is just the reverse. There are some provisions of bonds that we need to talk about. Sinking fund, callable bonds, and convertible bonds. Sinking fund is, as it says, there's a reserve account to make sure that there's enough money in the account to repay the bondholders when the bond is due. The callable provision we've already talked about, that's in there. It allows the bond issuer to pay off the principal before the maturity date. But remember, there's usually some sort of a bonus in that. That's not the right term, but you understand, a premium, excuse me, you're going to pay to the bondholders because you exercise this callable provision. Just remember one thing, just because a bond has a callable provision does not mean that it will be paid off early. Just it has a callable provision. That's usually a business decision. And then a convertible bond is exactly what it says, and we talked about this a little bit before, and that is if it's there, it can allow an investor to turn the bond into shares of common stock. All right. So how are we going to buy securities? Well, we have to go through a stockbroker. And this person, and I want to take the, use the term person and company interchangeably here. The person or company is a registered representative. Now, a company usually has the authority to buy and sell securities because he or she has a seat on the securities exchange, like the New York Stock Exchange or the NASDAQ or something else. And that person is authorized to execute trades, buying and selling. And he or she is normally referred to as a stockbroker. The stockbroker is an individual who works for a company, and it is usually the company that has a seat on the exchange. Sometimes it's an individual, but normally it's the company. And this person, the stockbroker, is an authorized agent or representative, if you prefer, of that particular company. We have some online trading services, TD Ameritrade, E-Trade, Scottrade. What I would tell you about online trading services is before you make any trade this way, do your homework. Now, I do not mean to say that any of these companies are into nefarious dealings. I don't mean to say that at all. What I mean to say is you need to do your homework so you know exactly what you're doing, because you're not going to get a lot of help here. You doing this, of course, there's the charge. The charge is normally less than going through a registered broker. Not to say these people aren't registered, but it's a different way of operating. Just make sure you know what you're doing before you're doing it. Now, this particular slide, and by the way, we're going to talk about this a little bit more next week in risk when we do the bonus chapters. These are the criteria for investment. The risk of the investment, we'll talk about that. How much you're going to get back, how long you have to hold it. For instance, if you're buying a bond. Liquidity means how quickly it can be turned over into cash, and what the tax consequences are. So the first thing you need to do before anything else is determine your risk. If you're a young person, and I'm going to say somewhere in the ages of 20 to 35, for instance, your tolerance for risk is most likely higher than someone who is at retirement age, 65 years of age or older. And so you're more willing, a younger person is more willing to tolerate risk. And I want to tell you that if you are interested in getting into the stock market or buying bonds issued by companies that are not, well, let's just change the securities market, buying stocks and bonds, bonds not being issued by the federal government, or municipal bonds that are backed by something, then you have to understand that there's risk here. It's not like going to the bank or the savings and loan where your deposits are federally insured. There is no federal insurance in the securities markets. So you have to understand that. And then yield just talks about how much you're going to get back over time. If anybody tells you that you can buy this particular security and you're going to get back 10% every year, year after year after year, you better look at that person with a good deal of mistrust. The stock market has been very good over a period of time, but most of the time it does not return, even individual stocks, 10% return year after year after year after year after year. And then tax consequences, you need to pay attention to that. because if you buy and sell stock, then it depends upon how you're going to go there. You need to talk to your broker or financial planning agent to determine whether or not it's going to be of value to you to sell certain things, because it may raise you in the tax bracket. So that's something you need to do. That's for your own edification. This is what you should do before you make your first investment, as it says here. Take an investing class. By the way, you can do that through Morningstar. Have a conference. Go to your library. Check out some books and do things of that nature. This is the return since 1926 of various classes of stock. Small company stocks have returned 12.2%. Treasury bills, which are the lowest here, 4.1%. So, have to factor that in. Now, what's inflation? Will that keep up with inflation long period of time? This particular slide, and I'm not going to go through this. What this says is diversifying your investments. And you may change this depending upon this formula here, depending upon your age bracket. But I want to cover this over to you if you're into an IRA at your work. Many times companies want you to invest in the company stock, and that can be good or it can be bad. Well, let's say it's good. Well, what you're doing here is you're putting all your eggs in one basket, and that is never a good scenario. So, be willing to maybe put some money into buying company stock, but look for other ways to diversify your portfolio. And by the way, there is no company can make you buy only their stock for an IRA. Okay, let's move on here. These are just things that you need to help with investments. You need advice, help with 401k plans, retirement planning, etc. What I would tell you about retirement planning right now is that we constantly hear that most Americans do not have enough money saved for retirement. Do not get yourself caught in that situation. Start saving today. We'll talk a little bit more about that next week. Start saving today. Save what you can and have a plan and stick with it. These are perceptions of the market. Bulls are saying everything is going to continue going up, 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 up. And the bears say, wait a minute. We've reached our apex. Things are going to start going down. Right now, if you paid attention to the stock market, it has been going up. It's over 20,000. Whatever that means, and I don't mean to be that smart aleck, but it's hard to figure that out, what that means. But it is that in that rarefied air. When you think about where it's moved in the 1980s, which is not that long ago, the stock market had just nudged over 2,000, and now it's over 20,000. So the market has been going up, but there's some angst in the market. People are saying, really not sure it can go this far. It has been driven by the increase in them has been driven by good earnings for companies. We can only hope that continues. However, this bull market, has been running pretty long for a long time after we got out of the depths of the recession, so they tend to lose their steam after a while. When that's going to happen, I don't know. Please don't misunderstand me here. I am not a prophet of gloom and doom, but it can't continue to go up. I think there's going to be a correction, and it'll be sometime this year. And I just hope the correction isn't that large. Here's what you're looking for in stocks. Blue chip stocks are going to give you a good return. Growth stocks are exactly what they say. Income stocks are going to give you a return on what you put in, and then you're going to get some other penny stocks are very cheap. Obviously, that's what they call penny stocks, and obviously you get on the ground floor and get a lot. Capital gain is the difference between, and notice it uses the word positive, so it means upward, difference between what you bought a stock for and what you sold it for. And if you do that capital gain there, you're going to have to pay tax on the capital gain. That's why it's difficult to sell stocks and mutual funds. And if you're into that business, get some advice before you sell it. The stock splits are exactly what they say. You own a share of stock, or let's start with 100 shares of stock, and the stock is worth $10 a share, so that's $1,000. XYZ Corporation, you own those shares, says as of tomorrow, 15th of February 2017, people who own common stock will now have two shares for every one. So that means tomorrow you're going to own 200 shares of XYZ Corporation stock. Does that mean that you now have 200 shares of stock worth $10 a share? No. That means for the most likely you have 200 shares of stock worth $5 a share, or that $1,000 again. So it just means that you own more stock. However, over a period of time, you're hoping that stock will increase, and so then the value will go up. Notice the split causes no change in ownership and no change in investment's value, which is what I just said. Nobody can tell a company, hey, you've got to issue a stock split. Just doesn't happen. That's not something that, there's no requirement here. Buying on the margin, I would tell you to be careful if you do this. Obviously, it can be a good strategy. The downside is when the broker calls the margin, you have to pay. You don't get a pass on that. You don't get to say, oh, I need to wait till next week. No. You pay when it's due. And this is what happened, and part of the problem we had with the Depression in 1929. A lot of people bought stock on the margin, and they had to pay when the brokers called the margin, and they couldn't pay. So that cost a lot of money. This particular slide gives you understanding stock quotations. It is very simple for you to read. It is in figure 19.4 in the text at the bottom of page 547, and I'm not going to go through it for you. It's very, very easy to read. These are financial news and research sites. Again, not something that I'm going to discuss. Here's some bond investors ask one of the things. Do you have to hold a bond to maturity date? No, you don't. How can I assess the investment risk of a particular bond? You can go to various and sundry websites and they'll tell you that. Morningstar can give you that information. Junk bonds, my advice is stay away from them. Mutual funds are a great way for a first-time investor to get into the stock market. The organization that you work with, a broker, I will tell you one that I have, my wife and I've worked with for many years, is T. Rowe Price. I don't get paid any money for mentioning that, by the way. They buy stocks and bonds and sell them to securities to the public. What happens is you have a number of people buying the same thing. So we have a number of people buying, and we pool that money, and it helps the fund. Exchange traded funds, ETFs, they're stocks and bonds the same way. They're traded like securities on exchange, but more like individual stocks than mutual funds. What I would tell you is if you're interested in doing either one of these, do your research first. We don't need to do that. These are the percentage of people owning mutual funds. These are the varieties of electronic traded funds, traditional, niche, and exotic. Again, get a professional help before you make those investment decisions. This is a mutual fund quotation. Again, it's very easy to read. You will find this in your text at the top of page 551. Then what we're going to do next is to look at the final figure that I wish to discuss with you in this particular chapter, and that is comparing investments. This is not something that I'm going to spend time reading to you or telling you about because it's pretty self-explanatory. You need to determine the investment is on the left-hand side as you look at it. You need to determine your level of risk, then what you're looking for in income, and then whether or not you're going to have some growth there, otherwise known as capital gain. Take some time before you determine that you want to invest in the securities market. Do your research. Contact a certified financial planner if you know one. Many of your local banks and savings and loans have someone that does that. And then do your own research. Do not get into a mutual fund or any other type of security without understanding the risk. That is very important to understand the risk. If you don't understand the risk or you're a little concerned about the risk, then the best advice is do not invest. All right, that brings us to the end of chapter 19. It is 5:17. We're going to take a short break, come back at 5:20 and cover chapter 20, which is money, Federal Reserve, and savings institutions. Please come back at 5:20. Thank you. Yeah, thought. All right, we're back. It's 5:20, chapter 20, money, financial institutions, and the Federal Reserve. Let's look at our learning objectives, explain what money is and what makes money useful, describe how the Federal Reserve controls the money supply, trace the history of banking and the Federal Reserve System in the United States, classify the various institutions in the banking system, briefly trace the causes of the banking crisis and explain how the government protects your funds during such crises, describe how technology helps make banking more efficient, and finally, evaluate the role and importance of international banking, the World Bank, and the International Monetary Fund. All right. What is money? Money is anything that people generally accept for the payment of goods and services. And of course, it varies across continental divides, continental boundary, that's continental, country boundaries, not necessarily continental boundaries. In Europe, there are around 20 companies, 20 countries or more that use the euro. The United Kingdom uses the pound. It has used the pound even before it got to BRICS. It did not use the euro. And every country that is within the European Union does not use the euro as their currency. Barter has nothing to do with money. It is the exchange between two people, I'm just going to use that as an example, of goods and services that may not be of equal value, but it is something that each side wants. And the best example I can give to you is one that a student gave me some years ago when I taught this class in a face-to-face mode. And I asked the class to give an example. And the best one was, the woman said, I had some furniture that I wanted to move, or I needed to move, or have moved, whatever the right term is. And I knew someone who owned a truck. And I said to him, if you will move this furniture for me, I'll cook you a chicken dinner. And so they struck a deal. And we could say, well, probably moving the furniture was more expensive than the chicken dinner. And we don't know why the guy, it was a man, wanted the chicken dinner. But that's what he did, and they struck a bargain. These are the standards for a useful form of money. And it has to be portable. It means that you could carry it around easily. Easily divisible. Now we know that a dollar is worth 100 pennies, and 20 nickels, 10 dimes, 4 quarters, 2 half dollars. It has to be relatively stable. It means it's going to last a while. We know that coins will last longer than paper, and there's a continual discussion as to whether we ought to have more coin in circulation than paper. Paper tends to win out, and it's not something we really need to talk about. It has to be durable. And the stability, of course, means government stability, and I didn't really say that correctly. And it has to be unique. It has to look different. It has to have something that tells us what it is. Now, why do we want money that is something we can carry around in our pocket? Well, many years ago, actually, I should say many centuries ago, around in the 1600s, the medium of exchange used in Holland, now known as the Netherlands, was a tulip bulb. Now, can you imagine how much space you need in your clothing to carry around, or your pocketbook or purse to carry around 100 tulip bulbs? What happens if you had to carry around 1,000 or 5,000 or 10,000? So it's pretty easy to see that that's not going to last long, and of course it didn't last long. We also know that there is a new movement to a digital coin known as Bitcoin. I cannot tell you a whole lot about that, but this is where people are making transactions and nothing tangible exchanges hands. So what's the difficulty is the last thing it says down here on the slide, and that is it's very difficult to tell what the value of a Bitcoin is. But I can tell you, I think without too much fear of contradiction, that we're going to see quote unquote virtual money taking over real money sometime in the future. I would expect before the end of this century, maybe even sooner. What we deal here now with is the money supply. And this is the money that's made available by the Federal Reserve. M1, M2, and M3 money. And M1 is money that can be gotten quickly. That is paper money, coins, and things like traveler's checks. M2 money is M1 money plus savings accounts, mutual funds, and things of that nature. And then M3 is everything that's in M2 plus big deposits from institutions and money like money market funds. I'm not going to talk about that. This just gives you a little graphic of how long paper currency lasts. Again, that's something that we need to discuss. But notice that the dollar bill lasts longer than the $5 bill, even though there's more of those in circulation. Something I cannot explain, but it's there. Money milestones, 1956, Congress established the dollar as the minimum wage. $10 to go to move for a movie in 2001 in New York City. And then there's a few other things there which we really don't need to talk about a whole lot. Some money facts here again, not something that really something we have to discuss, other than to tell you that 2/3 of all U.S. denominated $100 bills are outside the confines of the United States. Now, exchanging money globally is something we need to look at because value of money, it really says it's the amount of goods and services you can buy with the dollar. We have a falling dollar value, a rising dollar value. A falling dollar value means that you're not going to be able to buy as much as you used to be able to buy. Now, there's a little bit of a conundrum here as far as I'm concerned. If the dollar has fallen in value against other currencies, what that really means is that you cannot buy imported goods, the same amount of imported goods as you used to be able to. A gallon of milk, if it still costs $2, and I'm probably dating myself by saying $2, should probably still cost you $2, as long as it is domestically produced. A rising dollar means you're going to be able to buy more goods and services that are imported. And so what we have today is a relatively strong dollar on the international market. And I'll give you an example. I'll give you two examples. The last time my wife and I traveled to Europe was 2 years, almost 3 years ago now. And we made a trip to France, and the euro was trading at about $1.37 or so to the dollar. In other words, if you wanted to buy €1, you had to give them $1.37 in U.S. currency. Right now, the euro is trading at about $1.07. It's $1.06 something. I'm not going to get into those fractions. Another corollary is the British pound. Now, it's been a longer time since my wife and I have been to the United Kingdom, specifically to England. But right now, it is trading around $1.25. For the most part, since 2000, before this BritX hit, which was last June, the pound was trading around $1.60. So you can see that you go over there now, even though it's going to cost you more, you could buy more at $1.25 than used to be able than the $1.60. What makes the dollar fall and rise depending upon other countries. We're going to get to that in a second. A lot of it has to do with speculators. And the speculators think that the dollar is strong, it's going to stay strong, it probably will. And many things are denominated in dollars, even though they come from other sources. For instance, oil, a great percentage of the oil on the market, on the world market, comes from places outside the United States, Venezuela, and of course the other OPEC countries like Saudi Arabia and places of that in the what's commonly referred to as the Middle East. Russia, of course, is also a large player in oil. The sale of that is denominated in dollars. So if you see oil is selling for around $53 a barrel, which was yesterday, even though it's talking about light sweet crude, which comes from Texas, that's a benchmark. The Brent crude, which is also a benchmark, that's oil that comes from the North Sea, is usually a little higher than that. We'll say $54. But that's how it's denominated. That's how it's sold and traded. It's in dollars, not in some other currency. So speculation has a lot to do with it. Countries also may devalue or increase the value of their currency against the dollar, and that has something to do with it as well. And then some currencies, some countries peg the value of their currency to the dollar. Doesn't mean that they're equal value, but they peg it. So if the dollar goes up, their currency goes up. Pardon me, if their dollar is devalued or goes down in value, I should say, then their currency goes down as well. These are the 5 major parts of the Federal Reserve System. It's not something you have to commit to memory, but the Federal Open Market Committee is very important. Just know that there are 12 Federal Reserve banks, and then each federally chartered bank belongs to the Federal Reserve, is a member of the Federal Reserve. That's a better way to say that, not belongs, it's a member of the Federal Reserve. This particular slide, you can see figure 20.1 on your text. This just gives you the location of the 12 district banks. Not something, again, that you have to worry about or commit to memory. This, though, is something that you should look at because it affects each and every one of us. And these are the 3 tools that the Federal Reserve uses to manage the money supply. The reserve requirement, the open market operations, and managing the discount rate. Managing the discount rate is what is most probably impacts us as individuals more than anything else. And that brings me to the lecture discussion question for this evening, which I'll repeat at the end. And that is, there is widespread belief that the Federal Reserve will raise interest rates in March, which is just 2 weeks from today. And so the question is, if the Fed raises interest rates, will that be good for consumers or bad, and why? And the second part of that question is, will raising the interest rates be good for foreign investors or bad for foreign investors, and why? You'll have to do a little digging in the text to figure this out. Make sure that your answers are in your own words. So if the Federal Reserve raises interest rates in March, which it's widely expected to do, will that be good for investors or bad? Why or why not? And the corollary to that is, if the Fed raises interest rates in March, will that be good for foreign investors? And that means countries that invest in the United States bonds and et cetera. Will that be good for them or bad? Why or why not? And please upload your responses to the forum section. And I'm not going to change the due date on that. That is still due by 11:50 this Thursday, February the 16th. This gives you a check clearing process through the Federal Reserve. I'm not going to spend a lot of time on it because that's kind of a busy slide. What I am going to tell you is that the Federal Reserve has closed several of its check clearing facilities because more people are paying their bills online. This is a similar type thing that is happening to the IRS, Internal Revenue System, right across the river in Covington, Kentucky. Now I'm a Kentuckian. I no longer live in Covington. There's a large IRS processing center there that is due to close soon because more people are filing electronically, filing their taxes electronically. So this is another way the internet has changed the way we do business in this country. And we can expect more changes as we go down the road. The Federal Reserve was established after, as a consequence of the cash shortage system, a cash shortage that occurred in, pardon me, in 1907. Many people say that J.P. Morgan, a very influential financier in those days and bank owner, actually precipitated that problem. Whether that's true or not, I really can't say. He did offer to help get the government out of the quandary that it was in by loaning the government, I believe, if I remember correctly, $25 million. That isn't even noise change as far as we're concerned today. So the Federal Reserve was established in 1913. And notice down here, all federally chartered banks have to join the Federal Reserve. Now, I stress that federally chartered, because in some states there are still what is known as state chartered banks. I'll give you an idea of the difference here. If you bank with, let's say, U.S. Bank, that's a large bank, most people know that, or Wells Fargo, or Bank of America, or a company like that, you can go to any one of their branches in any state, and as long as you have an account, you can make a transaction. Now, if you're, a foreigner, what I mean by foreigners, they don't know you. They may ask you to produce some identification, a few other things, but you can still make a transaction. When I was in the Army many years ago, I was stationed in, I was at a school in Texas, and I opened a bank account just in case I needed to be able to get to a bank. And my wife was still back home in Missouri, where not that I lived there, but I'd been assigned to Missouri. And she had a very good job, and we decided not to move her and my younger son, who was still in high school. So I opened this account with the bank. But if I wanted to bank with that particular, I can't remember the name of it, I had, because it was state chartered, I had to go back to that branch. I could not go to another branch and conduct my business. I had to go back to that branch. So that's a little bit of a difference. This gives us the largest bank failures in the United States. It's not a pretty picture. I really don't want to go into that, but it's something that, yes, there's a concern about, and we have to always be concerned about that. And by the way, banks fail on a fairly regular basis, so it's not something that only happened during the last crisis or during the 1929 Depression. This is our banking system, made up of commercial banks, which we know, savings and loans, credit unions, and then non-banks. A commercial bank is in the business to make money, and they make money by lending you money, and then you pay interest on that for a home mortgage or something of that nature. And then, of course, they offer services like checking accounts and money markets and things of that nature. Two types of customers, although one customer can be both a borrower and a saver, or depositor, as it says there. Demand deposit, that's the technical name for a checking account. And what that means is you can go to the bank and you can say, hey, Mr. Banker, or hey, Miss Banker, I want to take all my money out of the checking account right now. And they have to give it to you. A time deposit is different. That's their savings accounts, and money markets will go into that some little bit different. The bank can say, you have to give us notice when you want that money. In a certificate of deposit or a money market, it's considered a certificate of deposit, earns interest. It's going to be delivered on certificate's maturity date. Now, what that means is, if you take your money out, say, I want to liquidate my certificate of deposit. In other words, I want my money. The bank is going to charge you a penalty. And the penalty is you will not get a certain amount of interest. Now, you're going to get your money back. You put $1,000 in there expecting extra interest, but you have use for that $1,000 or you need it. You're going to get that money back. You're not going to get that interest rate or that interest that you expected to get, whatever it happened to be. That's the penalty you pay. And so there may be some other penalty that they charge for early withdrawal for that type of thing. Much different than a regular savings account. There's no time on a regular savings account. A savings loan is, in many cases, performs the same functions as a traditional bank, as a commercial bank. Notice it has both savings and checking, et cetera, and it provides home loan mortgages. That is the primary purpose that savings and loans were created many years ago. Actually, it had two purposes: to promote saving and then to promote home ownership. Of course, regular banks now have mortgages, et cetera. And so, and many years ago, you could not have it. Well, could not have. You didn't. Most savings loans didn't offer checking accounts. Savings accounts, yes. Maybe other time deposits, yes. Maybe certificates of deposit, yes. But not checking accounts. That's all changed. And notice here what they were known as years ago: thrift unions, thrift organizations, promoting savings and home ownership. Credit union, these are nonprofits, much different than either savings and loans or commercial banks, owned by the depositors or financial cooperative. A lot of times you have to belong to an organization of some kind to belong to the credit union. A large credit union around here in Cincinnati is the GE Credit Union, General Electric. So you either have to work for General Electric or have some other relationship with General Electric before you could join a GE Credit Union. The big thing here, they're going to offer all the services, but the big thing is, since they're a nonprofit, they don't have to pay income taxes. Non-banks, we do the same thing. Life insurance companies, et cetera, pension funds, brokerage funds, et cetera. I'm not going to get into all these other than to tell you that those things are available. If you want to do business with a non-bank, you may need to check about whether or not your savings are federally insured, et cetera, et cetera. I would suggest they're probably not. And the reason I'm saying that is I don't do a lot with, I shouldn't just say I don't do anything with non-banks in the way of banking. So I'm really not up on that area, but just be careful when you do any of that type of things. This is why we find people in doing online banking reduces theft and things of that nature. Well, we know what the banking crisis did. It affected, it says here, 5 million households. I think it probably might have been larger than that because everything wasn't adjudicated, if you will. Everybody didn't say that. Banks really had a lot of problems. Most of that problem, however, was on Wall Street. It was not on Main Street. That doesn't mean to say it didn't have ripple effects. It did. And what it did cause, among other things, is that even today, while banks, large banks are, for the most part, now of course Wells Fargo created their own problems, but large banks are very profitable. It's very difficult for anybody other than a very well-to-do person or who has mega assets to be able to get a loan, maybe to start a small business, to increase small business operations, et cetera, et cetera. And we have to be concerned about that because part of what helps drive the economy not only is the startup of small businesses, but it is banks lending money so businesses can expand. Businesses expand, they hire more people, they buy more equipment. So those are things that we really need to be concerned about. This is the banking crisis, and of course the government had to do the bailout, which meant us, weans, use an expression in bad language. We did that, we taxpayers. The government has gotten a lot of that money back. How much is gotten back, I can't tell you, but it has gotten a lot of the money back. This is how you as an investor in a bank, a commercial organization like the bank or commercial bank or savings loan or credit union, have your money protected. FDIC, independent agency of the government, insures banks deposits up to $250,000. That is the same thing with the Savings Association Insurance Fund, SAIF, and then the National Credit Union Administration, NCUA, again provides $250,000 coverage. We know that electronic funds transfer and debit card things are big issues today, and it's things that really help us move along. There are a couple of other things for us to know about. One's a letter of credit. That means that the bank will pay the seller a given amount if conditions are met. And then the banker's acceptance promise the bank will pay a specified amount at a particular time. And finally, money exchange allows companies to go through bank to exchange currencies used in a particular country, dollars to euros or to pounds or to something else. That, I believe, brings us to the end of what I want to cover for tonight. And so I just will repeat the lecture discussion question one last time. And that is, the Federal Reserve is expected to raise interest rates, that's the discount rate, at its meeting in March. Now, I'm not sure exactly what day that'll be. So the question, there's two questions, or a question and a sub-question, and that is, if the Federal Reserve raises interest rates, will that be good for consumers or bad? Why or why not? And if it does raise the interest rates, will that be good for foreign investors in the United States? Why or why not will that be good or bad? Please upload your responses to the forum section by 11:50 this Thursday evening, February the 16th. That brings me at 5:48 to the end of our video and audio and video lecture presentation for this evening. We will be back next week to present bonus chapters A, C, and D. It'll take us about the same amount of time, and I look forward to you checking in again with me next Monday night. Please remember that the session ends on the 26th. I cannot accept any assignments that come to me after the 26th unless previous arrangements have been made. Please remember the 26th, 11:50 p.m., all assignments and forum posts must be submitted. After that date, I will not accept anything past that unless we have made previous arrangements. So again, thank you for your participation this evening, and good night.